Hello everyone. Good morning to all. Welcome you all in this session. I hope every one of you is fine. So quickly confirm me, am I audible and visible? Let me check. Okay, yes, everything is good. Now, so today in this session, I will discuss about Module C, the MCQs of Module C of paper ABFM, and this is your mini marathon. Okay, so in this mini marathon, we will be discussing all the important topics with the help of MCQs. And I have already taken two sessions, that is Module A and Module B of ABFM. And ABM also, I have taken all the sessions. So if you have not watched those videos, kindly go and watch whenever you get time. Now, let's start the session. So what is the today's agenda? That we will be discussing questions, and through questions we will be covering all the important and relevant topics. In this session, this is our agenda. Now, so this is very important slide for you all. Those who have not yet enrolled in our Crash and Cracker batch, kindly enroll it soon. Okay, soon we are starting our Cracker batch. In Crash batch, what benefits you are given? That in Cracker batch we will revising. So there is the revision of all the concept, all important and relevant concept. And in Cracker batch, whatever concepts we have revised, we will do the practice of questions. We will do MCQs in our Cracker batch. So both the benefits you will get in this single all-in-one combo. The Crash, that is a revision series, and Cracker batch, that is of practicing more and more MCQs. Now, medium is entirely English. So 100 revision sessions will be there, then live practice sessions will be there, mock test will be provided to you, and the case study, high level MCQs, and some numerical questions will also be provided to you in this Cracker batch. So enroll it fast. Now, the first question. So total in this session, we have approx 25 questions. Okay, for every question, I will provide you 5 seconds to answer. If not, then I'll tell you the answer. Now, first question. The module C is all about your corporate valuation. Whenever we are purchasing or acquiring any company, how we do the valuation of that company, that is all about in this chapter through the different multiples, through different earnings, through different approach. Okay, we consider all those things for doing the valuation. Now, question first, what it says that patents, software, copyright, mining lease, license, spectrum, these are examples of what? Now, patent, software, if you don't know these spectrum license, but you can easily get the answer that patents, copyright, these are your intangible assets. Now, intangible assets are those assets which we cannot see them, neither touch them. Now, these are type of intangible, and in intangible, one word is also added, fixed or current. Now, we know that intangible assets, they give you the valuation for more than 1 year. Okay, patent is not for 2 months or 3 months, it is more than a year. If the software which you have used in your system, it is not for 2 months or 3 months or 8 months, it is more than a year. So those assets which give you the benefit more than a year, that is called fixed assets. So it is henceforth, it is intangible fixed assets. The valuation of each of these assets is unique depending on the factors, like some will have book value, market price, EPS, etc. All right, so option A is the answer. Now, so intangible assets are these are non-current. Non-current means these are fixed assets because they are expected to generate value for the business over a period of time longer than 1 year. So in current assets, we have inventory, okay, but in intangible assets, we have patent, trademark, goodwill that provide you long-term benefit. Now, goodwill reputation of the company is not for a few months, it is for more than a year. Now, question number second, that is a dividend growth model. Tell me, calculate and tell me the answer. Dividend growth model. Now, the shares of the company are quoted at rupees 40 per share. Last year, the firm had a dividend of rupees 4 per share. Now, the estimated growth of the company is approximately 16%. Now, growth of the company is how much? G is given 16%. Now, dividend of the last year it is provided to. Dividend last year. Now, dividend last year is denoted as DO. Now, this is given how much? That is for 4. Now, required rate of return is, that is R is what? That is 20%. Now, you have to calculate what is the market value of equity shares as per the dividend growth model. So, dividend growth model, the formula of dividend growth model is equal to D1 upon R minus G. Now, what is given? What is P? So, first you have to calculate the dividend of the current year. Dividend of current year. Now, what is the formula of dividend? DO 1 plus G. Now, DO is how much? DO is 4 into 1 plus G is what? Growth is given 16%. Can we write 0.16? The 16%. Can we write 0.16? Yes. So 1 plus 0.16. Now, 4, 1.16. Calculate this. 4 into 1.16. That is rupees 4.64. Now, 4.64 is what? That is the dividend of your current year. Means D1 is equal to what? D1 is equal to 4.64. Now, we have got D1. We know what is R. R is 20%. Then we know growth. Growth is 16%. Now, put the value on this formula. So, P is equal to D1 is what? 4.64 upon R is 0.20 minus 0.16. So, you will get 4.64 upon, that is 0.04. 0.04. Now, if you will calculate 4.64 divided 0.04, that is 160. So, what is the market value of equity shares? That is rupees 116 per share. All right. So, this is how you have to calculate the using dividend model. Any doubt in understanding this? Option C. How option C came? Correct. Sure. Now let's move. So this is the explanation I have provided to you. So later on you can download the PDF and you can go through once. Now next question. Which of the following statement is correct? It is from mergers and acquisition. Which of the following statement is correct? Okay, let me share it in the WhatsApp group also. Now, in reverse merger, a smaller company acquires still smaller company. Means a small company is acquiring small company? No. In reverse merger, a smaller company acquires large company. Small company is acquiring large company? Yes. So, reverse merger is what? See, merger means normally when two companies are merging together, the similar nature of companies or the different nature of companies maybe. Now, but in reverse, reverse is the opposite. So, what is the opposite of merger? So, when any big company or any unlisted company is acquiring the listed company or any smaller company is acquiring the larger company, this is what happens in reverse merger. All right. Now, one request from you all is that if you're watching this session for the very first time, please subscribe the channel. And if you feel that questions are good, videos are helpful to you, then you can like the session as well. Now, next question number 4. To be done. The ABC Corporation is a well-established company with a consistent dividend payment. Consistent dividend payment means every year the value of the dividend was same. Okay, regular dividends were the payment of regular dividends were there in that company. Now, in ABC Corporation, now they are considering using H model for valuation. Which of the following statements about H model is accurate for their situation? You have to find the correct option. The H model. The H model predicts that the slow growth rate will suddenly slow down after a given amount of time. ABC Corporation is an ideal candidate for the H model as per they pay substantial dividend at the present time. Now, see, already the dividend payment was what it was consistent throughout the year. Now, in this H model, what it says that, see, H model says that the growth is very high in the initial level. Suddenly, the growth goes down and it remains forever until and unless it does not get stable. So this is the pattern of the growth in H model. So this is how the growth of the company depends upon this H model. Suddenly it goes high, then it goes down, decline frequently, and then it reaches at the stable position. The H model is used when companies' dividend are not growing at a fixed rate, but instead they start high, low decrease, and until they become stable forever. So it is more realistic than the traditional method, the traditional two-stage model, which just assume that there is a sudden shift from high growth to the steady growth. But it does not happen in real. The growth is always in a gradual position. So H model, it assumes that initially there is high dividend growth. It won't stay forever, but it will reduce gradually until and unless it reaches at the stable position. Now this, the fixed number of years, the stable position is called the 2H years, where H is what? H is the half the number of years. That is, if it is of 10 years, so we will assume that it is of 5 years. So half is means what? That is 2H years. Okay, so dividends are expected to grow at slow, then stable rate forever. So at this dividend payout and the cost of equity, it is remain constant throughout the year in our H model. And this model is developed by whom? The two person has given this model, that is Fuller and Sia. So these two people have given this model. Now H model assumes earnings growth starts off low. No, H model is not applicable to it because it predicts fluctuating dividend payout. No, H model is also suitable where the dividends payout is fluctuating because every time not the dividend will always be same. It will for 2 years it will be same. Then it will the value will definitely change. So in this option B is the correct answer. Why? Because H model it as they pay substantial dividend at the present time. So in present scenario, the dividend payment is what it is the consistent regular dividend payment is there, but the dividend is growing at a gradual stage, then declining, and then it moves at the stable rate till forever it does not achieve that position. Okay, so this is the graph of H model. Now, next. So H model is designed for situation where a company starts with high growth rates, then it gradually decreases. So high growth rate, then it gradually decreases these rates over until it reaches a stable growth, until it reaches a stable growth. So this is what? This is the stable growth. So it is GA, this is GA when moving at a constant rate. Okay. Now, so this is the formula of the H model and the formula is very, very important. Now, here GA and GL is denoted as the short term and long term. So DO is what? DO is the dividend. Now, GL is the length of long term growth. So that is GA we can say. DO is the dividend of previous year. H is the time, the half time, like 10 year is there. So we will take H as 10 by 2, that is H is equal to 5 years. Okay, then required rate of return minus long-term growth, required rate of return minus long-term growth in both the cases. So this is the formula of your H model. Now, next question number 5. Which one of the following is not a primary approach towards corporate valuation as per IBS 105 norms? So which of the following is not the approach that comes under corporate valuation? So in corporate valuation, we have seen different approaches, which is not the part of that approach among all the four. Income approach is there, market approach is there, cost approach is there. But profit and loss approach, this is not any type of approach related to corporate valuation. Now, income approach is what that suppose I am purchasing any company, okay? I am the acquirer and I am purchasing any company, a company. Now, when I'll do the valuation of this company, I will ask the owner of company A that in future, what are your expected income? Okay, how much income you are going to make in future? Tell me the value of that income, and then on the basis of that, I will do the valuation. Now, market approach is what is the value that is prevailing in the market. So if you have the similar type of company, I will do the valuation of this company. The valuation of this company comes 10 crore and you are asking 20 crore. So this is not the appropriate valuation. So if the company is same, if the working method, everything is same, first I will compare your company with another company, with competitor company, and then I will do the valuation. That is the market approach. And cost approach means what? That how much cost your company is making in order to earn the value in its one share. That is approach. So market approach, it is applicable when there is an active market for the intangible. Information about price in arm's length means the comparable prices. If you know, then we use the market approach. If you are comparing the another company with the company that you want to purchase. Income approach means what future cash your company will going to generate considering discounting. So it is based on the present value of all the income. And cost approach is what that relies on the principle of substitution. Principle of substitution means if I get the same type of company in less value, then definitely I'm going to purchase that company. Why I'm paying more amount for your company? Like the value of your company is 10 crore and the same company is also having the value 8 crore. So definitely I'll go and purchase that company. Why I'm waiting? Why I will pay 2 crore more for the same company if I get the same type of company at 8 crore. So that is principle of substitution. If not this, then this. Yes, so all the three are the approaches of corporate valuation except to profit and loss. So income-based approach, what is the future profit method? How much money it will make in future, the business will make in future considering discounting. So not without discounting, considering discount. Right? Now, then market-based approach is what? It is a comparison method. You will compare one company to another company and after that you will do the valuation. So how you will compare? You will compare with the multiples. So different companies, first you will calculate the multiples and then after calculating computing the multiple you will apply that multiple to the company which you want to purchase. So how you will calculate the multiple? So you will calculate the multiple of the competitor company with its earning, with its EBITDA, with its profit, with its income. And that multiple is used to do the valuation of the company which you want to purchase. That is called comparison method. So by comparing it with similar companies in the market. So this you can use with the help of different multiples. Like company A sells for 10 times its profit. Now PE ratio comes 10. And if the company profit is 5 lakh, so 5 lakh, and this is the multiple 10, that is the value of the company now becomes 50 lakh. So this 10 times comes what? Company A. Company A sells for 10 times means the value of the company A is 10 times. And with this value, the same value I'm using the company which I want to purchase. Now, cost-based approach is what? That is the asset method. That is what it would cost to build the business today. So if I'm using your all the values, your all the asset, what is the value of the asset in the market? How much it will take cost? How much it will cost to build your business today with the use of substitution method? Like machines, you have 20 lakh. Building, the value of building is 30 lakh. Okay, land is 50 lakh. Now total value is 1 crore. So this is the actual value which I will give to you while purchasing your company. Right. Now, case study is given. Case study is given on WAC and Gordon model, discounted approach, and non-discounted approach. So all different approaches are included in this case study. Now, what does the case study say? Now, Capital First Bank Limited is there. Now, this bank is a mid-sized bank. It is a private bank and it is a growing bank. Okay, its loan portfolio, retail loan portfolio is what it is in a growing stage. Now, this bank was being evaluated for potential merger. Now, another bank wants to merge this bank. So, this bank was evaluated for getting merged into another large financial group of services. For accurate corporate valuation, the analyst has applied the discounted cash flow valuation models and non-discounted cash flow valuation models both. Now, in discounted cash flow valuation, two approaches are used. First is the WACC and the Gordon growth model. So, bank has used the future free cash flows for 5 years using discounting, and the rate of WACC is given, required rate of return is 12%. The terminal value, the final value using the Gordon model is growth rate is given 4%. That every year the growth rate of this company is this company will grow at a rate of 4% every year. Right now, at the same time, the analysts have used the non-discounted method also. That is, they will do the valuation of the company without discounting. See, valuation of a company can be done with two methods. One following discounting, if you are considering discounting, and if you are not considering discounting. So, non-discounted approach, one method is comparable companies. The same when you are comparing your company, your bank with another company or bank. And precedented transactions means the old transactions. Okay, the previous transactions. It was used to benchmark against bank to book. So, PB ratio, PS ratio, these are what? These are the multiples when we are using comparable approach. Now, though easier and faster, these methods did not capture capital first, aggressive growth plans, and digital information pipeline. Now, so acquirer has favored that by considering these two methods, the discounted cash flow approach is the suitable method for the acquirer. So, acquirer has gone with discounted cash flow. The DCF model, due to its forward-looking nature, despite sensitivity to assumption. Now, based on this case study, we have certain questions. Okay, so precedented transactions is what? It is the transactions when it is done to know the actual value of your company while comparing the value of the competitor's company. Like if you want to know the price of your house, you can check the recent sale price of similar house in your area. And whatever value, at what value your similar house is being sold, you can use that value for doing the valuation of your company. So you can check recent acquisition prices of similar companies. So precedented transaction means the previous transaction that took place in your society, in your location, and you can use that value for comparing your company. Now, question is given first. In DCF model used for Capital First Bank, the terminal value is the final value. The closing value was derived using Gordon growth model. Now, in using Gordon growth model, what are the key risks arises if growth rate, we have assumed that growth rate is overestimated. Means if the growth rate is 10%, we have estimated that it is 20%, it is 15%. So what are the risks that are related to the growth rate? So definitely when you are assuming that the growth rate is very high, it means that the enterprise is having the inflated market is there in that enterprise. So overstatement of terminal value. So terminal value is increasing very high, which leads to the inflated enterprise valuation. Now, in capital first valuation, what might discounted cash flow model might be considered more appropriate? So why company has opted for DCF, not non-DCF? Why DCF? Because see, in discounting, the actual value you will get. Excuse me. Okay. By doing the discounting, you will get the present value of all your future cash flows. So it depicts the more appropriate version. So DCF captures future growth and cash flow specific to the bank. That is why the Capital First Bank has opted for DCF approach rather than non-DCF approach. Now, next, which valuation input directly affects both discount rate and equity? Which affects directly both the discounting rate and the equity value in DCF model. See, it's written over here. That is, the bank has used the future free cash flow for 5 years using weighted average cost of capital of 12%. So weighted average cost of capital means the required rate of return. Required rate of return means the discounting factor. So that is the fact. Now, in context of bank evaluation, what is the limitation of non-discounted? Why company has not used non-discounted? Because non-discounting they does not consider the actual value. Okay, why? Because they ignore inflation, they ignore synergies. So it may not adjust for unique deals, specific premiums or synergies. Synergies means when two companies are coming together, they are working together, so they will create more value comparatively to the companies when they are working individually. The value of two companies A and B will always be greater than value of company A alone working or value of company B alone working. That is called a synergy. Okay, so I have given put all the answers over here. Now, next question number 10. It is the question based on the types of merger. So we have horizontal, vertical, co-generic, and a reverse merger. Now, horizontal merger is what? When the merger is taking place in similar type of business. So, two businesses that have recently merged operate in the same market. Vertical means when the merger is happening like the buyer-seller relation or the supplier-buyer relation. So, this type of merger takes place have buyer-seller relationship. Now, co-generic means when two companies are merging, but one company is selling the core product and the second company is working on its subsidiary product. So, acquiring company and the company merging when they are connected in some way, whether it is through fundamental technologies, industrial market, or market segment. Now, reverse merger is a merger when any unlisted company captures the market of the listed company, acquires a larger publicly shared listed company. So all are related parallelly. So 1, 2, 3. Now, question number 11. Which of the following statement about valuation approaches are correct? You have to find which statements are correct. Now, we have seen that market approach, it uses comparable transaction data. Yes. Cost approach uses the replacement that how much money it will take to build the company right now. Okay, now the income approach discount cash flow to the present. Yes, what income approach says that what actual value you will going to create in future. So what are your expected earnings in future? So it discounts all your cash flows. It helps in finding the present value of all the future cash flows. Present value of all future cash flows. So 1, 2, 3 correct now. Book value approach is a part of income approach. No, book value approach is not a part of income approach. The book value approach is a part of your like balance sheet approach, cost approach, asset based approach. Okay. So this is the explanation. Now, next. What is the meaning of corporate restructuring? Restructuring means re means what? Re means again, and structuring means forming again the company. So process of reorganizing a company structure, its other operations or finances to improve the performance or efficiency. Now, next question number 13. This question is based on your case study, the Kodak case study, which is given in your book in unit number valuation and mergers. Kodak case study. Now, you are a business consultant and you want to use Kodak case as an example to highlight the importance of adapting. Okay, why Kodak company? Why this company failed? Because this company does not follow the new market trends. This company does not follow new technology. This company was busy in acquiring the Fuji films, and so this company deteriorated. Okay, business of this company fell down. So this company does not adopt new technology, market changes. So this is the lesson we have learned from Kodak case. Now, so what lessons can be learned from Kodak case among the following options? So Kodak focus on traditional film photography was successful. Is it successful? No, this was not successful. Kodak management was quick to adapt emerging technology. No, this is entirely wrong. If Kodak has adopted the technology, then Kodak company was something else right now, as of now. But it's the Kodak company have not adopted any new technology at that time. Kodak company was busy in acquiring Fuji films, and so it lead to the deterioration of this company. So Kodak failure to embrace digital technology and adapt to market trends resulted in its decline. Yes. And so the workforce also reduced, the profit also reduced, everything declined that time. So option C is the correct answer. Okay, so option C accurately reflects the. Now, question number 14. What is white knight in case of takeover difference? Now, suppose two companies are there. One is the acquired company. This company wants to acquire another company. Now, the company which the acquirer wants to acquire, that company is known as the target company. Now, in acquisition process, in takeover process, what is white knight called? So, white knight is what? Tell me. So, white knight is a type of the person, or we can say an independent third party that helps the target company so that the target company could not acquire under the acquired company. So white knight, it helps the target company. So independent target company sought by the target company to counter a hostile bidder. So because see, if acquisition, merger, takeover, if this is happening, the normal scenario means without hostility, then it is okay. But if it is a hostile acquisition is there, means the target company does not want to get acquired, but acquiring company wants to acquire the target company. So in this case, the both the parties are not agreeing on the same matter, so it becomes a hostile takeover. So in hostile takeover, the white knight comes and saves the target company from being acquired. That is option B. So white knight is what? It is a friendly company that comes to rescue another company from being taken over by hostile or unwanted bidder, called black knight. Now the black knight is the acquired company, and white knight comes to help that target company from being acquired by the hostile takeover. Like company A is about to be taken over by company B, right? Now company A does not want to get acquired in company B, so company C will come. Company C will act as a white knight company to help the company A, who agrees to take over company A in a friendly manner. So company A will take over company C will take over company A so that company B cannot target company to get acquired in a hostile takeover. Right? So that is called white knight in mergers and acquisition. And black knight is a company who is acquiring without the permission of another company. That is called black knight. Now, next, which of the following are special features of financial services companies? So financial services companies, these will come under the special cases of valuation. So in special cases of valuation, we have financial services companies also. So these are such companies. If one financial company wants to acquire another financial company, so what are the special features or considerations that company will consider before acquiring? So this company has some features. The financial company takes the use of debt for earning income. They provide loans, they take deposits from the public. They are heavily regulated sector. Yes, the norms of RBI, the norms of Banking Regulation Act is over there. Now, difficulty in measuring reinvestment. So, banking company, they, because see, not the same type of earnings the financial enterprises will make. Sometimes earnings will be high, sometimes earnings will be low. So, it becomes difficult for the financial companies to do reinvestment and to measure reinvestment. So yes, difficulty in measuring reinvestment. So all the options are correct in financial services companies. Yes, done. Now, so these are all the options listed for financial services companies. Now, they use debt to generate income. They are heavily regulated sector, and measuring reinvestment for future growth is challenging for these companies, and it is also quite difficult to do the comparison between two banking institutions or financial services. We cannot compare the PNB with Canara Bank. Every bank has their respective policies, they have their internal policies they have adopted, so it's quite difficult to compare these two banks together. Now, so what are the features? Use of debt for earning income, then it is highly regulated sector, difficulty in measuring reinvestment. Now, these companies, they have to maintain capital adequacy norms also, the CR ratio, risk-weighted assets. Difficulty in choice of multiple CS. These companies are difficult to do the comparison. They have to maintain a lot of provisioning for their losses, and government is also included in this. Now, next question number 16. So XYZ Corporation is there. Now this company is a tech startup company, and this company is growing rapidly since when the company has started its operation. With its annual growth rate, everything good. Now, however, this industry analysts have believed that this exceptional growth will slow down significantly after 3 years. Okay, this company is growing, but this company will also lead to the decline, the slowdown in the next 3 years, and then it will be more stable growth pattern. Now, which financial model would be most suitable for valued XYZ company? So when there is the exceptional growth, okay, after that, this company will slow down significantly in the next 3 years. Till then, it does not achieve the growth pattern. So that is the two-stage growth model. So one is the exceptional growth is there, then this company will slow down gradually, okay, and this company will get a more stable growth pattern. That is two-stage model. Now, so two-stage model, what is the difference between H model and two-stage model? In two-stage model, two growth stages are there, but in H model, there is the gradually declining growth. Now, here the two distinct growth stages are there, and here the growth is declining. Okay, the gradual decline growth rate is there. Now, it is stable growth. After that, it starts with high growth, then declines gradually to it starts with high growth, then declines gradually, and then it maintains a stable growth. This is abnormal growth for few years. Okay, then it is the having the stable growth. Now, sudden shift from high growth to stable growth, and there is the declining. It is happening gradually, not suddenly, but gradually. Two stages are there. Here one formula. Now, like grows at 20% for 5 years, then stabilizes at 5%, and grows at 15% but reduces slowly to 5%. Here, the growing is what that is 20% for 5 years and then stabilizes for 5%. Here, the growth is 15% but reduces slowly 5%. Growth is every the growth is 15% and the declining is 5%. So declining is comparatively less than the growth rate. Clear? So this is the difference between the H model and two-stage model. Now, next question number 17. So this question is the based on the multiples, the enterprise value multiples, EV multiples. Now, JJ companies ROIC. ROIC is return on invested capital. Return on invested capital. What is the returns you are earning when you have invested, when you have done the investment? That is 20%. Now, growth is 11%. Depreciation and amortization is 9%. And tax rate is 30%. Now, JJ's WACC is 13%. That is weighted average cost of capital, overall cost of capital. Now, calculate JJ's EV upon EBITDA. So, EV is enterprise value upon EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. So, for this, you have to learn the formula. This is the formula. Now ROIC minus growth, that is return on invested capital is how much? 20%. We can write 0.20 minus what is the growth? It is 11%, 0.11 into 1 minus DA. DA is 9%. That is 0.09 into 1 minus 30% tax rate 0.3. Okay, now upon ROIC is how much? 0.20, 0.13 minus 0.11. That is WACC minus 2. Now, if you will calculate, you will get 14.32. So, this is what? This is the JJ's, the company, JJ company's EV upon EBITDA multiple. So, this is how you have to calculate. You have to learn all the formulas. 7 to 10 formulas are there of EV enterprise value. You have to learn, and I have already shared the formula sheet in my group. So those who are watching as paid members, they know it very well. Now, question number 18. Under section 72A, for how many years can amalgamated companies they can carry forward their accumulated losses? For how many years that company can for? Like, suppose the company has faced a huge loss in their company, and if that company is being acquired in another company, now the acquiring company can can carry forward or set off that the company's losses for how many years? 5, 8, 10, or 15? That is 8 years time is given. So till 8 years you can set off and carry forward the losses of the acquired company. Like company A is acquiring company, company B is target company. Now this company B has already made a huge losses, but still company A is acquiring company B. Why company A is acquiring company B? Because suppose the profit of company A is 60 crore. And the loss that company B has made, that loss is 8 crore. Now, if company A is acquiring company B, to 60 crore plus minus 8 crore, this loss will also be a part of company A only, na? Now, plus minus minus. So now, where the company A has to pay income tax on 60 crore, now company A will pay the income tax on 52 crore. 8 crore will be deducted. Okay, now this 52 crore, this is the taxable income. So that is why most of the companies, they purchase the loss bearing company or the negative earning company, so that they can show their tax liability comparatively that is less. And this 8 crore, the government has said that okay, you can carry forward this 8 crore, but for a period of up to 8 years, not more than that, under section 72A, the amalgamated companies. Now, next question number 19. Again, it is the question in the Gordon growth model. 2 questions are there. Okay, here is one question. Now, Gordon growth model. The company PQR just paid a dividend of rupees 8 per share. Dividends are expected to grow at a rate of 5% per year. That is the growth is given how much? Growth is given 5%. Now required rate of return R is how much? R is 9%. And you have to find the intrinsic value of the stock. Now intrinsic value means the P, the we can say the market price of the share. Market price of the share, that is P. So you have to find PO using the Gordon growth model formula. Now, what is Gordon growth model? Gordon growth model formula? Tell me, anyone? See, Gordon growth model formula is P is equal to T upon R minus T. Just now we have done this. Now, already the values are given to you, but just pay dividend of 8 per year. Means this is the past year dividend. DO is given how much? That is 8. So first you have to find the present year dividend, that is D1. Now, how to find D1? DO 1 plus G. This is the formula. DO is 8, 1 plus growth is how much? 5%. Can we write 0.05? So 8 into 1.05. So what is the answer? Calculate 8 into 1.05. So 8.4 means the dividend, the D1 is what? That is 8.4. Now P equals to, this is D1. D1 comes 8.4. R minus D is 0.09, required rate of return minus 0.05. So 8.4 upon this is 0.04. Now 8.4 divided by 0.04, that is 210. So rupees 210. So the intrinsic value of the stock is rupees 210 using Gordon growth formula. This is the answer. All right, understood? Any doubt in this? Yes? Now, next question. So this is the explanation I have given to you. 210 is the answer. This answer is same? Yes. This same. Now, next. Question number 20. An investor is analyzing a company that does not pay regular dividends, but generates the cash flows after meeting all tax obligation and reinvestment need. Now, investor has analyzed that when the company has made profit, now the company, first the company has paid all the obligation, then whatever amount is left, the company is not paying to its shareholders. They are not paying dividend to its shareholders, but company is keeping that money as retained earnings for reinvestment need. Now, the investor choose a model that discounts these residual cash flows at the cost of equity. Residual cash flows means the money which you have kept in your company for future use, your retained earnings, your internal accruals. So that cash flow is used at the cost of equity to find the intrinsic value of the company's equity. So now which model is fit for this? So if we are finding the residual value at the cost of equity, so we will use the cost of equity model. So that is free cash flow to equity model. Why? Because we are finding the intrinsic value of the equity shareholders, of the company's equity shareholders with that residual cash flow. So free cash flow to equity model. So option B is the correct answer, right? So FCFE model discounts cash flow available to equity shareholders at the cost of equity. Suitable for companies not paying dividend. So when the company is not paying dividend to their equity shareholders, so this model is used to find the actual value of your equity shareholders so that you can pay dividend to them. If the value is coming high, it means dividend is good for the company. If value is coming low, it means that what you are doing, that is also good. You are keeping money, you are retaining the money, you are retaining your profits for future use. So that is good. But if the value is coming high, So you have to pay dividends to your shareholders as well. Now, next question. A company has just paid a dividend of 5 per share. Now, the dividends are expected to grow at a constant rate of 6 per annum. If required rate of return is 11, now again you have to find what intrinsic value of the share, that is P. So PO is equal to D1 R minus D. Now what is given? See, growth rate is given. Again, growth is 6%. Then required rate of return is 11%. And just paid a dividend of 5%. Means DO is given how much? 5. So D1 is equal to DO 1 plus G. So DO is what? That is 5. 1 plus growth is what? What is the growth rate? That is 6. So we can write 0.06. Can we write or not? Now calculate and tell me what is the answer coming quickly. Those are watching 5 into 1.06. So 5 into 1.06 is what? That is 5.30. Upon 0.11, R is what? 11% minus growth is 0.06. So 5.30 upon 0.05. That is rupees 106. So option C is the correct answer. All right. Done this question. Now, next question is see. In every question, you were seeing that the question is asking you to find the constant growth dividend model. Means every year this is the same type of growth. Now, but here it is given zero growth. Means no growth is there. Zero growth is there, and you have to find dividend discount model with zero growth. Now, firm's equity shares are currently selling for 80 rupees. Last dividend paid was 8 per share and the company is following the growth policy. Now, what is the formula for zero growth model? Zero growth dividend discount model. So that is D1 upon K. Now, what is D1? So D1 is 8 upon K is what? 0.10K, or you can say D1 upon R. So R is required rate of return 10%. So that is rupees 8. Okay. Now, why we are taking a dividend 8%? Because see, no growth is there. The growth rate is what? It is 0. So the answer will come as 8 only. Okay. See, calculate and check. Now, DO is given how much? 8. We know that we have to find D1. Now, how to find D1? The formula for finding D1 is DO 1 plus G. Now, what is DO? DO is 8 into 1 plus, because there is 0 growth rate. So, this is the 0. Now, 8 into 1 is what? That is 8. The answer is coming same. So, we have put as 8 over here. So, that is your zero growth rate model. All right. Now, so this is again the explanation I have given. Now, next question number 23. In a leveraged buyout, what is leveraged buyout? Which of the following factor is most critical in determining the success of the transaction? Leveraged buyout means, see, suppose you are the acquirer, okay, A Limited, you are what? You are acquired. You want to acquire company B. Now, company B becomes what? Target company for you. Okay, after doing the valuation of target company, you have found that the target company is costing rupees 50 crore. but you only have 30 crore in your company in your hand to purchase the company. So what you will do, you will go to the bank, you will ask for 20 more crore, means you will take debt from the bank, that is loan from the bank, and then after taking that debt, you are purchasing this company thing. So leveraged buyout means, leverage means what? A support provided to you. Support is given from bank, that is debt. So taking the help of debt and then purchasing another company, that is called leveraged buyout. So the availability of collateral for securing debt financing, that is called leveraged buyout. Okay. Now, so what is leveraged buyout? Acquirer takes loan to buy target company. Now acquirer use the target company's revenue to pay the loan. The acquirer repay the loan by using the target's company's revenue to pay the bank loan. And acquirer has paid the bank loan also. Now the target company is also in the hand of acquirer. Now the acquirer is selling this target company at a high rate to earn huge profit. So this is how the LBO works. But the basic meaning of LBO is taking the help of debt to buy the target company is called leveraged buyout. So option C is the correct answer. Now, what is green mail? The green mail, it is a type of strategy which is used by the companies for anti-takeover defense. Now, what is the example of green mail? So green mail is what? A company repurchases its own shares from the hostile acquirer at a premium to discourage the takeover. The company increases its debt load to make itself unattractive to the acquirer. The company issues stock option to employees to make takeover more expensive, or company sells of non-core assets. Now, what is green mail? Green mail is, suppose this is the target company, acquired company A, and B is the target company. Suppose company A has acquired the shares of company B. Now, what company B is doing, if company B does not want to get acquired, company B says that okay, you have bought the shares, you have bought shares of my company, like one share costing rupees 100. Okay, you have bought one shares by giving rupees 100 to me. Now I will buy your shares worth rupees 120. Means company B is asking the its own shares at the rate of premium. The value of the share is 100 rupees, but company B is paying premium to company A so that company A can get more amount and company A sell the all the shares of company B to that same company. That is what the green means. So company increases it, the company repurchases its own shares from the hostile acquirer at a premium. So company is repurchasing its own shares from the acquired company at a premium so that acquired company can discourage this takeover. So green mail is what? It is the exercise of buying number of shares in target company to threaten them with hostile takeovers. And later the target company repurchases its own share from the acquired company at a premium so that the value of the shares they get, the acquired company get extra amount. So acquiring company is known as green mail. So what are the available choices? It can accept hostile takeover at this decision. It does not accept hostile takeover and it pay heavy price. So two options are available for the target company. Either target company is okay with this hostile takeover or target company repurchases its share at the more premium, or we can say the highest value, the premium, to repurchase its own shares. So to stop this anti-takeover techniques. Now, question number 25. Which of the following is the primary purpose of minimum alternate tax? The last question of today's session. So what is MAT, minimum alternate tax? See what happens now. There are many companies, what they do in order to show less tax liability, they show less profit to the government. Now, they show more expenses. Okay, then they do Then they make the income is being distributed to different subsidiary companies to show the less tax liability in the parent company. And if there is less tax liability, then the tax will be paid less to the government. So government, what it says that, okay, you are doing all these tactics to pay less tax to me, so I will offer you one tax that is called minimum alternate tax. So this is the tax the company will should not use the loopholes where the many companies they were using loopholes to show less tax liability. So government has introduced the MAT, that is minimum alternate tax, means every company has to pay a minimum amount of tax even if their taxable income is low, zero. Later on, they will refund, the money will be refunded to them, the tax will be refunded, but right now they have to pay a minimum amount of tax to ensure that every company pays a minimum amount of tax. So that is minimum alternate tax. So what does the MAT rule says now? This MAT in income tax, it falls under this section 115 JB, important. Now this section states that company calculates its tax liabilities, and if the tax liability is considered higher of the following two amounts, that would be the final tax payment. So normal tax liability and MAT, whichever amount is higher, the company has to pay that amount. So normal tax liability is calculated based on the taxable income, the standard tax, and MAT is what? The 15% on your book profit. If your book profit is 10 lakhs, so you have to pay 15% of 10 lakhs. If your book profit is 20 crore, you have to pay 15% of 20 crore. Now, whichever amount is higher, considered the higher of the following two amounts. So government will take that amount. Okay, so this is MAT for the companies who always save their tax by showing less income to the government, by showing less tax liability to the government. So option B is the correct answer. So far we have done 25 questions as of now. And again, one important slide for you all. So if you have not yet purchased our plan, if you have not yet enrolled in our Super Elite All-in-One plan, so do it fast to make your preparation best, because very less time is left. Exams are near to you. So in this Super Elite plan, you will get 2000 plus live classes, special sessions will be there, previous year questions will be discussed, special doubt clearing sessions will be there. You can tag your mentor to ask any doubt. So that is all in one plan. All the notes, mock tests, and live classes plus PDFs and recording, everything will be provided to you. Now, do like the session if you feel it is beneficial to you. Share it with other people also. Subscribe if you have not yet subscribed our channel, that is CAIIB English Medium. CAIIB English Medium. And this channel is for Hindi medium. So subscribe both the channels. Okay, now so let's meet you in another session. Tomorrow we we will discuss the MCQs of Module D of paper ABFM. So last chapter, last module is left in ABFM, so we'll discuss tomorrow. Okay, so let's end the session. Let's conclude this session. So enjoy your day. Let's meet you tomorrow at 3 p.m. in the evening. Okay, bye bye everyone. Take good care of yourselves.